Hello and a very warm welcome to you all. I'm Lillian Chin, Director of Client Partnerships with La Trobe Financial. Thank you for joining our February investor call. We are pleased to have started the new year in really good shape after what has been an extraordinary time for investors, the economy, and the community as a whole. In this update, key La Trobe Financial executives will provide an update on current economic topics, plus an overview of our sector and fund. We will start with a look at the Australian macroeconomic environment. At all times through the past 2 years, Australia's economy outperformed expectations again and again. As we move further into 2022, the Australian economy continues to perform strongly, even against a backdrop of residual pandemic risk. Across all key economic drivers, there is a consensus of strong outcomes in the coming 2 years. Unemployment, initially predicted to rise into double digits, is now at just 4.2% and expected to fall further. Participation rates are high, which indicates that we are getting towards full employment. An amazing outcome 2 years into a global pandemic event. After prolonged lockdowns and the recent impact of Omicron, the economy is still forecasted to grow in 2022 by between 3.5% and 5.5%. Household savings have been supercharged and sit near historic highs. Of course, there will be pockets of softness, and we will continue to see volatility across the market in the period ahead. Risks will come and go, be they economic, geopolitical, or otherwise. At this moment, it is worth noting that Australia's economy still has significant dry powder to protect against any adverse conditions and volatility. I will now pass to Troy Stratton for an overview of specific economic drivers with our CIO office update.
Thank you, Lillian, and hello all. I'll begin with inflation, which is one of the most talked about features of the global markets right now. Economies rebounded very swiftly from the initial impacts of COVID, which caught many producers and supply chains by surprise. As global consumption preferences shifted away from services to physical goods delivered to our homes, furloughed staff in factories, ports and logistics further aggravated this. A rebounding economy, supply constraints and a sea of cheap money from central banks' quantitative easing programs have universally created an inflationary event. In Australia, underlying inflation has entered the Reserve Bank's target range of 2 to 3% following many years of suppression. Rebounding wage growth in both private and public sectors sees many query whether this inflation is transitory or an enduring longer-term shift. We note that the Reserve Bank and other central banks generally still expect underlying inflation to decline towards their targets over the coming year, with quantitative easing concluding and supply disruptions resolved. The consequence of a strong economy marked by low unemployment, rebounding GDP, wage growth, and the re-emergence of inflation is the prospect of increasing interest rates. In Australia, the pricing of government bonds has continually tracked upwards as expectations of future rate rises firm. While the consensus for rate rise is through 2022 or early 23, the Reserve Bank has taken a very dovish line. The RBA intends to wait until it is convinced underlying inflation is sustainably within the target range, which gives it time to see if current inflationary pressures do in fact ease. Noting bond yields and the upward moving fixed rates on home loans, perhaps much of the heavy lifting will be done by market forces. The credit fund has continued its strong performance, servicing over 70,000 investors both directly and through financial advisors. At the 31st of January, the credit fund now holds some $7.2 billion in assets under management. Each of our portfolio accounts again recorded benchmark outperformance, demonstrating their value as quality source of low volatility variable income. The deliberate feature of our portfolio accounts from the outset of COVID-19 was a tilt towards holding excess liquidity as a buffer against volatility. We note that following a period of elevated liquidity in 2021, we are now returning towards full investment. This move will stabilise income pressures within the portfolio as you have observed in recent months. Across our pool portfolios, we continue our consistent track record of zero capital losses, and we have honoured all redemptions at maturity since inception of the fund. As Deputy Chief Investment Officer, I am pleased to confirm that asset quality remains high. The impact of Omicron was not felt in our portfolios, with borrower pandemic hardship relief at just 0.1% of the portfolio holdings. Arrears too sit at just 2.9% across the entire credit fund at the end of January, a healthy position we are eminently comfortable with. I'll now hand to Michael to discuss the residential property market and market lending volumes.
Thank you, Troy. Hello all. The Australian residential property market remained stronger than expected across December and January, supported by high demand and low supply. National house price growth remains strong at 1.1% for the month of January and is up 22.4% year on year. While it's continued to moderate from peak growth 12 months ago, this is the highest annual rate of growth since 1989. Buyers remain active in the market. Total listings are at a multi-year low, while sales volumes remain high. As listings increase, new supply comes online, housing affordability bites, and macroprudential regulation cools sentiment, we anticipate price moderation through 2022. However, we note that long-term demand-supply fundamentals will see the market returning to excess demand again from 2023. As the housing market continued its growth trajectory, so too did the volume of new loan commitments across the industry. Following a slight moderation, total housing loan commitments rebounded to finish December at a new monthly high of $32.8 billion. Month-on-month growth of 4.4% comprised owner-occupied housing credit growth of 5.3% and investor housing credit growth of 2.4%. We've previously noted that growth over the past 12 months has drawn attention of the regulators. APRA and the Council of Financial Regulators continue to closely monitor residential mortgage lending and have flagged additional macroprudential measures should any risks in the system continue to build. We conclude our February investor call noting a strong start to the 2022 calendar year. The team and I look forward to bringing you updates each month, and we thank you for your ongoing custom. We remain committed to acting as careful stewards of your capital, and our team remain on station to assist with any queries you may have on 1800 818 818. Thank you.